Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Very excited for today's show. We have none other than Christy Schnurle with us today. So, Christy, welcome to the show.
Thank you. I appreciate you inviting me to be on the show today. Really
Yeah,
looking forward to it.
absolutely. Let's start out by talking about you. So, tell us a little bit about yourself and what you've been doing and how you got into real estate and multifamily.
Sure. Yeah. So first, where I'm from, I'm been in California for most of my life. I currently
Hmm.
live in Southern California. I've been in the multifamily real estate space for 18 years now. I went to school at UC Irvine, went to college there,
Hmm.
and with a psych degree, thought that I was going to go into, private clinical practice. And instead,
Yep.
as I approached graduation, I had professors actually like discouraging me from doing that because they said it's
Hmm.
just too tough of a business. So I was like, okay, now what am I going to do? Right.
Yeah.
So I had some friends at the time that were actually working for a syndication firm, and
Hmm.
she was leaving her position and they needed someone to replace. So I came in and so I sort of accidentally fell into the real estate space in that way. So I spent 5 years with that company working
Hmm.
in syndication. We focused just on tax credit properties during my time there. Well, that's all that they still do, but I was
Hmm.
in acquisition, spent 5 years. So I learned due diligence, underwriting, negotiating partnership agreements, kind of
Hmm.
all of that base foundation that I've carried forward. Did
Yeah.
that for 5 years. And then I ended up, my father is in sort of more of the construction development space. And
Hmm.
25 years ago, he had started a firm. And shortly after I left the syndication firm, I started doing some side projects helping him out with his business, and then
Hmm.
have kind of full time fallen in there for the last decade. So for that period of time, what I've been doing in that business is CDK Enterprises, and we
Okay.
help multifamily developers to reduce construction costs. We're looking at, efficient design. What does it look like to reduce those construction costs and help people on the
Mhm.
back end? So a lot of different things there.
Awesome. 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 Understand you have a Opal Equity, which is your
Mhm.
company as well.
Yeah, so a
That's,
couple of years
yeah.
ago, yeah, I partnered with that to do
Mhm.
what we do there is we help
Mhm.
investors to get into institutional grade multifamily opportunities.
Okay.
And that's kind of what our focus is right now. So helping people, it's for a lot of it, our investors are people who
Hmm.
haven't really invested in this type of product before. Maybe they've been
Hmm.
interested in real estate or interested in syndication, but feel a little overwhelmed or they're not sure about it. So we
Hmm.
do a lot of education on the front end to help them to understand what the structure is, what it looks like, how to evaluate different deals if they're right for them, that
Okay.
kind of a thing.
Awesome. Awesome. Now a lot of people listening to this show, they're kind of taking their first steps into multifamily. Can you talk about, why you decided to go that route? I mean, you're not operating, you're helping investors find good operators, but can you talk about why you went that route and what you think the benefits are?
Yeah, so it's interesting
Hmm.
because I think I didn't specifically choose multifamily. It kind of
Hmm.
chose me in the sense of, right out of college. I kind
Yeah.
of just followed this path, right? And I've just sort of have been in this sector. However,
Yeah.
I did think that I wanted to own and operate a handful of years ago. I
Hmm.
started going down that route and I thought, okay, well, if I'm going to start to go in and go after some of these opportunities myself, what does that look like?
Yeah.
And I immediately defaulted to, well, what's my skill set, right? And it came from acquisition. So I very much identified with that pillar and
Hmm.
started underwriting a lot of deals and kind of looking at them through that lens. And what happened after probably the 75th deal that I was looking at that didn't
Yeah.
pencil at all, because this was maybe 2023 when like the gaps
Yeah.
between everything were,
No, nothing really penciled, and you're probably better off for not having bought anything that year.
yeah,
So,
I don't think there was anything to
yeah.
buy that made any sense. But anyhow, the bigger realization at the time was that
Hmm.
although I could do something, I had the skill set to underwrite and to be looking at those deals in that way.
Hmm.
I hated it. Like every time a new deal or opportunity crossed my desk, I was like,
Yeah.
I don't want to sit and spend a couple of hours underwriting this thing right now. And
Hmm.
so for me, that kind of made me dig deeper of like, well, then what is it that I want to do? What am I excited about?
Yeah.
And what is my path? Right. And I didn't even think about the fact that like you can get in, especially as a beginner. I think we're so primed to jump in and want to do our own thing, right? Like I
Hmm.
want to, there's this big, beautiful dream of like, I want to
Yeah.
own an apartment building. And you don't realize quite how much goes behind that. And
Hmm.
you really need strong partners around you. that have done it before, that know what they're doing, so that you're not jumping in without any
Yeah.
experience. And the challenge I think that a lot of people have in the beginning is partnering with people who have enough experience to help you along that path. But most of the ones that have too much experience or a ton of experience, it's like they already have most of what they need to make
Yeah.
each deal work, right? Like they don't need to take you on unless it's capital. So that's kind of how I ended up. I was like, you know what? I don't want to be underwriting these deals. I don't want to even necessarily go through and at this point jump in and have that be such a huge focus of owning and operating it myself. What I am excited about is the relationships, the people that I know in my network that are wanting to get into this, and for me to help them with that and to be able to be a part of deals I'm really excited about, like
Mhm.
institutional grade with fantastic operators that have been doing this for a decade or whatever
Yeah.
it is. And my path to do that was more of why don't I take my syndication background and do a fund of funds, like take what I understand about
Mhm.
all of that and structure and go in that way.
Perfect, perfect. A lot of good things there. And this comment's more for people listening. If you're sitting at a spot and you dread doing something, that's probably not where you belong, right? So, and the other point that I'll unpack from what Christy said is, every operator will take money. That's one thing that almost every operator, if you can come to an operator and say, hey, I can help you raise money, I can raise more money for you, you're going to get a lot of yeses, as opposed to people saying I've already got that. But well, cool. So let's talk about, that you mentioned institutional deals. Can we go a little bit more deeper into the why? I mean, what is an institutional type deal? What type of operators are you looking for and partnering with?
Yeah, so I guess when I'm saying that, it's more of
Hmm.
the quality and the type of a project
Hmm.
that has either already been operated by institutional money or ones that they'd be interested in investing in. And it's not
Hmm.
that it has to be that, but it has a lot of qualities about it that we like
Yeah.
to as especially as a fund of funds,
Hmm.
which maybe before I answer a question, I should back up really quick and kind of just tell people if they're not familiar what that means
Good idea.
because it gives
Yes.
some good context into why we've chosen this. So, a fund of funds is basically kind of like this sub fund. So,
Hmm.
we as an independent company create a fund that then invests into an opportunity.
Yeah.
So, the way that we typically structure it would be like a syndication. So, you have an operator who has their own fund that they've created to go take down apartment ABC.
Hmm.
And so we would come in and bring investors into our fund, which then invests. So we essentially become one big check
Yeah.
to the operator, where our
Hmm.
fund is sitting below them in the
Hmm.
position that the rest of the passive investors are sitting in. So it's a nice structure for raising capital because
Hmm.
it has a lot of compliance built in. You're able to bring capital in a way that works for, the SEC and
Yeah.
a lot of things like that. But I will say where a fund of funds is a risk is that because it sits in that LP spot and
Hmm.
you're managing a fund and pooling investors and putting them into there, you as the fund manager don't have any control in the deal. So you're
Correct.
putting a ton of trust into that main operator and that they're going to do what they said they're going to do. And at the
Hmm.
end of the day, you can't even control if you're getting reports or not, right? Like you're very much a regular passive investor in that way.
Yes. So your fund invests as an LP. Typically, how do you get paid with a fund of funds?
Yeah. So what we like to do,
Hmm.
we're really passionate about not diluting investor returns.
Hmm.
So what we do is we basically go in and we structure to where there's a spread
Hmm.
between what someone who's investing directly into
Okay.
the operator's fund, what they would be getting as returns, and then
Hmm.
what someone in our fund would be getting. And whatever that spread is in between is how we get paid. So we
Okay.
would get our fees. In like a standard syndication, you might have multiple share classes where it's
Hmm.
like maybe you have share class A and B that are giving you a 6% pref, 8% pref,
Yep.
whatever it is. And then you have a CD that's like, okay, if you have a larger, if you have 500 million or $1 million check, you can buy these share classes.
Yep.
They might mirror the same one, but have additional benefits where it's like, okay, instead of a 6%, like this is an 8%. That's just a simple straight example. But then
Yeah.
the difference would be that 2%, right? And so that's where we would come in and that would be paying our acquisition fee or an annual fund management fee, things like that.
Got it. Got it. Yeah. And that makes sense. And, we do different shares, different classes of funds on everything we do. And so exactly as I said, so you're getting the benefits of the the better class of share, so to speak, and you're living off of the difference between what the investor would normally get and what you can get with that better class of shares.
Correct.
Well, awesome, awesome, awesome. So we explained fund of funds. Now, when you talk institutional, you're usually talking, large properties, I assume, very large properties. Do you like the A class, B class, value add, stabilize? What type of deals do you really like to look for?
What we've been looking for over the
Hmm.
last couple years is more of like that class B, maybe class B plus, definitely stabilized, some value add, but the value add being very, very light,
Hmm.
especially in the market that we've been in. We're not looking for things right now where it's like we're depending on this full heavy renovation strategy to push rents up hundreds of dollars per unit, things like that, which there's nothing wrong with those plans, but they
Yeah.
leave a lot of unknowns. So for us, at least for the investors we have right now and what we're looking at, we're okay with taking deals that are definitely not as exciting from a return standpoint in offering those because they're more stable. If they've been
Yeah.
cash flowing consistently, they have a good track record. You have an operator coming in who's operated these types of assets for a long time. It's kind
Hmm.
of rinse and repeat. They're taking over and they're kind of just tightening operations. So that's really the kind of play that we've been looking for
Hmm.
this market that very well likely will shift, in the coming year
Yeah.
and as things adjust. But right now, that's kind of been what attracts us to those kind of deals. So they're much larger, where you're looking
Hmm.
at 150, 250, 300 plus units, larger properties.
Awesome. Now, do you have individual like markets or different metros that you like that you're focusing on right now? And why those markets?
Yeah. So we're somewhat agnostic in the sense that because
Hmm.
we're not owning and operating, we don't particularly care. And actually, we kind of prefer if they're not in the same market so
Okay.
that there's additional opportunities for investors. But I'm very conservative with what I look at. And I think part of that's probably
Hmm.
going back to working for the syndication
Yeah.
firm for 5 years. Our investors were all institutional. It was like the largest banks and insurance companies. And if you're underwriting for them, you're
Yeah.
going to learn to be so I think it got kind of baked in my bones a little bit, the conservative. But so I stick to kind of just the market fundamentals, primary, markets. We really don't explore like maybe some
Mhm.
secondary if it's strong enough, but like
Yeah.
tertiary right now, there are some that are tempting, but it's just not, at least during this current kind of part of where we're at in the market, it's not something
Yeah.
that we're considering.
Yeah. So overall, you've mentioned the word conservative, you're talking about the larger stuff. You're basically looking for things with a little bit less risk, a little bit less volatility for your investment philosophy.
Correct.
Yeah.
Yep.
Okay, got it. Got it. For people listening, there's a big difference between, a C class value add when you look at the risk profile versus 300 unit B class that's, more or less stabilized. It's one of them has a lot of unknowns, one of them is very consistent. So, okay, cool, cool. So, let's talk about challenges in the marketplace right now. What challenges do you have finding new good places to invest right now?
Yeah, I would say right now it's just
Mhm.
kind of it's low transactions happening.
Yeah, it is.
What we're doing is really kind of building relationships and
Hmm.
identifying people more than we are the deals. Because right now there's not a lot that's happening with deals. So it's really about identifying who might be a good fit in terms of an operator that we want to keep a pulse on when they get an
Yeah.
opportunity. Then that's an opportunity for us to take a look at it and see if it might
Mhm.
be a fit for our investors. So that's the biggest challenge would really be, at least from the Opal Equity, from
Yeah.
an investor standpoint side.
Yeah. Yeah. And I mean, are these type of operators receptive to you right now, or are they just not making purchases? What are you seeing when you're reaching out to people?
Yeah, I would say most are very receptive because to
Hmm.
your point earlier, and I think
Hmm.
that's something important for someone who's getting started to kind of realize
Yeah.
is that capital really is one of the most powerful things. So it's like if you can gain the skill set or have partner with someone where it's like you're connecting investors with opportunities, it opens up a lot more doors and you can get in much more easily. Just make sure you're responsible
Yeah.
with that role that you're taking on. But yeah, people are definitely receptive. It's more just like for us, if it's the right opportunity, or
Mhm.
if we're comfortable enough with kind of with the operator. We've had conversations with some people that they might have been doing it for 15 years and they've
Mhm.
been in the commercial space, but it may not be a fit for us because they've raised, they've put most of their own funds in all those years, which is an incredible quality And strictly from an investment standpoint, I admire it. And I would personally be like, yes, this is the kind of operator I want to invest in.
Yeah.
However, from a fund of funds, when your structure relies on the syndication structure of the parent fund, and you're mirroring that to some degree and trusting that they know how to do all that and that's
Mm.
something brand new to them, that's where it's
Yes.
like for us it's too much of a risk. So there's a lot of different things we're weighing when we're looking at something. So someone could be a fantastic operator, an
Hmm.
expert in what they're doing, and still not be the fit for
Yeah.
us right now in this market.
That's something I never really thought about. So with the fund of funds, it works better with somebody who's actually syndicating instead of just plopping in their, millions or tens of millions of dollars. Okay.
Absolutely. Yeah,
Interesting.
because it's structured with a fund of funds, you're
Hmm.
operating under a 506C most of it.
Yeah.
Most of the time. You probably could do it under like a CF or something else. I don't
I,
know.
I've done a 506B fund of funds, but they're kind of awkward. But yes, mostly a
Well,
506C. Yes.
yeah, because the thing with the 506B is that like if you're doing a fund a 50, it has to met, right? So if the
It has to
parent one
match.
is a 506B,
Yes.
then the fund of funds is a 506B. But the people in the parent one still have to know every single person in the sub one
Yeah.
because that's the nature of a 506B. So it's kind of like, well, then what's the
It is awkward.
advantage of pulling? It's like just pull everyone in or pull someone in as the GP, right, to bring that
Yeah.
money. But
Yeah.
yeah, exactly.
So, okay, got it, got it. Now, when vetting operators, you talk about compatibility, but what are some red flags for you? If they say X, it just kind of scares you away. And speaking of red flags, I'm wearing bright red right now, so we're talking about red flags in a bad way, not the type of
Yeah.
flags I'd wave at a football game, but yeah.
So I think for me, some of the red flags are definitely like I said,
Mhm.
one, I'm looking for track record. So it's like if
Okay.
someone has been doing this for about 5 years,
Mhm.
just because of the nature of like where we're at in the market cycle, that doesn't tell me a lot. So I'm kind of like, I want to know that
Yeah,
this person has exited. I want to know that they didn't just ride some golden wave through a good
yeah.
period of real estate. They were lucky with what they had and it performed well, right? Like I want to know that like if things
Hmm.
aren't going well or you can actually operate. So I'd say that's number one that we look through a lens. Like how long have you been doing it? And
Yeah.
like what does that portfolio look like? How have past deals gone? I would say too in conversations, if we're asking like how tell me about a deal that didn't go as you expected or the
Hmm.
returns weren't there and they're saying, oh, we've never had that happen or nothing bad, it's all been great. To me, that's a major red flag. And
Yeah.
then at surface level, that sounds great. You're like, well, isn't that what you want? You don't want a deal that goes badly. But
Yeah.
the
There's no perfect
reality,
deals. Yeah. They're
and the
right.
reality is you can be amazing. You could be an
Hmm.
A plus plus operator, could have a fantastic deal. And guess what? Something still can go wrong,
Yeah.
and it's like that's just the nature of the business and with any investment.
Hmm. Yeah, absolutely. Absolutely. And just in the last year, I think I've had three fires at three different properties. It doesn't matter who you are, what you're operating, stuff like that happens.
Yeah.
So if they're not talking about their things that go wrong, that's definitely a red flag. So I would think that's more trying to hide things myself. But well, awesome. Well, we're getting close to where we have to start, winding down here. So, Christy, I got a couple questions for you to finish up. Question number one, what's next for you?
Yeah, so next for me is really hoping this market turns soon and
Mhm.
bringing on
Right. Yeah.
we would love to have some good opportunities. We have
Hmm.
investors that are looking to get into things. I would certainly say that. We are working on kind of helping other people who are newer
Hmm.
into this space. So I'm really passionate about taking what I've learned over the last 18 years, breaking down some of the there's a lot of intimidation, especially in multifamily, because it
Hmm.
sounds like we're just speaking a bunch of jargon. It's another language. So I love just freely educating people. So we do a lot of
Yeah.
free Zooms and continuing to do that where we're teaching people the basics of like
Mhm.
how to look at these deals. What do these mean? How do they get structured? So whether you're a passive investor coming in and looking at it, or you're someone who wants to start raising capital, how do I do it? Where do I start? Like, what do I need to know? Those kinds
Mhm.
of things. We help people to do that. And
Yeah.
we're continuing to kind of grow that audience in terms
Mhm.
of people that are wanting to work together and kind of learn together and get into that space.
Awesome. Awesome. Yeah, those educational type offerings work really well for a lot of things. A lot of people who are reluctant to invest, if you start answering their questions, when it comes time to invest, guess who they're picking to invest with?
Mhm.
Not me, you, right? So now next to last question, and that's if you had to give somebody who's just starting out some advice, what would that advice be?
I would say be careful of shiny object syndrome because I
Hmm.
think, especially in the real estate space, so many people jump in and they want to do all the
Yeah.
things because you start meeting people and someone over here is doing this and someone over here is doing this and they all look really exciting. Take some self reflection, figure out where are my strengths, right? Am I a people person? Am I a numbers person? What do I gravitate to like naturally and what energizes me and excites me?
Yeah.
Then go out and find your missing pieces with it. So it's like if I'm a numbers person, I should pair up and kind of figure out who's a good fit with me to go look at whatever the types of opportunities. That's more of the people person. Like maybe we go
Hmm.
raise capital and I'm more of the analyst side and they're
Yeah.
more of the like investor meeting sides. So I think really self-assessment, self-awareness in
Hmm.
sticking to your lane, like put your head down and just focus on whatever it is that your goal is instead of focusing on what everyone else is doing around you.
I love it. I love it. Yeah. I mean, I mean, some people call it your superpower or whatever, but once you find that superpower and you're pushing towards your goals, everything gets a lot more simple. Love that advice. All right, last one. How can listeners learn more about you?
Yeah, so I would say I'm on most of the social media
Hmm.
platforms. So I do share a lot about beginning stuff with investing, multifamily general education, as well as
Hmm.
in the development and construction management space. So a lot of multifamily in general. So you
Hmm.
can find me on LinkedIn. My profile is my name, Christy Schnurle. Same with Instagram, YouTube and Facebook, all there.
Awesome. We'll put links to your social media in there. And you mentioned the webinars. Or will they be able to find the webinars following you on social media?
Yes, I usually do post that we're doing them, but more
Okay.
specifically, if you go to the opalfund.com
Okay.
backslash events, that page has whatever we have that's upcoming. So as we're releasing new educational information and
Perfect.
Zooms, we'll post it there.
Awesome. And for people listening, we'll put the link to that in the show notes. And we'll also put the links to her social medias profiles in the show notes as well. So you don't have to worry about, writing things down or spelling her last name. Just go click and the internet thing will whisk you away. But all right. Well, Christy, thanks so much for coming on the show today. Very much appreciate your time.
Thank you. It was a pleasure. Thank you again for having me. And I
Mhm.
think it's fantastic that people who are getting started have such a great resource here with your
Yeah.
podcast and get to hear lessons from so many people and have you guiding them. It's
Yeah.
fantastic.
Appreciate that. Thank you.